Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending May 3rd, 2024. I'm Preston Brent. Thanks for tuning in. Well, the week's theme is speed bump or wall. I'll get into that in just 1 minute. But if we take a look at how we fared this past week, all in all, it was a fairly strong week. You can see everybody was in the green for the week. Year to date, also everybody in the green. The Russell finally moved into the green, up 29 basis points year to date. You can see the PE trailing ratio, 12-month trailing ratio is 22.62. Forward is 20.68. I still think that's a little bit higher than it should be. Dividend yield is a 1.42 10-year treasury, coming in at 4.51. It's off about the prior week it was at 4.66, but the yields came in a little bit this week. I'll explain that in just a minute as well. Earnings yield at 4.74%. And we got the VIX coming down this week over 10% to close out the week at 13.49. And all in all, a fairly good week. Now, if we come over here and we look at the markets, you can see that it was a really volatile week. I mean, we had a lot of economic data hitting the screen. It's the second busiest week for earnings. We got a lot of Apple came out. They had a record stock buyback of 110 billion. And while the stock was up, I don't think deep down looking at their earnings, it was that strong. But that record 110 billion stock buyback, that's huge. Okay. So that kind of helped rebound the market after Apple came out. Well, the main driver for the week, though, was really the Friday jobs numbers. Non-farm payrolls came in at 175,000, less than expected. And it's the lowest number since November. So that missed signaled a little bit of a cool down in the labor market. Lower inflation pressures is what that means. And that means the Feds, obviously their path to cutting rates can be possibly sooner with weaker economic data. So we're in that bad news is good news for price action right now. But, probably most investors here were more so pleased in those job numbers, not for the 175,000 jobs, which was lower, but by the monthly wage increase. It came down. The year-over-year gain in wages fell to 3.9%. That's the lowest in almost 2 years. So that also helps bring inflation down, or at least put a lid on it. And the average hours worked fell back just a little bit. And we did get the ISM, the Services Manufacturing Index, on Friday, coming in contraction territory for the first time since December of 2022. So all of that data, bad news data from an economic perspective, suggests that these high interest rates are having an effect on the market, slowing things down. Yet earnings are still strong. So far, it's still lining itself up for a softer type landing scenario. But we still have a few things we've got to get through. Okay. Um, the other thing is this past week, we had our Fed chair do his press conference. Obviously they didn't cut the rates, but markets weren't expecting a rate cut. But they wanted to listen to his press conference and what he had to say. And his comments, of course, were more dovish than expected. That also helped the market, although we had some really interesting price action where the markets moved up 60 or 70 points and then sold all off going into close. Really crazy few days there. But net, he was more dovish than hawkish. And he said that given the current restrictive policies that they have, the next rate move will be more than likely lower rather than higher. So the markets took solace in that. Okay. So all in all, fairly good from a price action perspective this past week. And of course, when we go over to Europe, you can see the Eurozone's GDP, they came into the upside. Okay. It registered a gain of about 30 basis points in Q1. But they did revise Q4 to going negative 10 basis points. And that contraction for Q4 put them in an official recession in the second half of last year. Okay. Now, that's why I believe they're coming out of it. They've been bottoming for a while now. So I do believe that they're going to be on the upswing. And we'll see strength in the euro over time, over the next 90 days as that continues to manifest itself. Meanwhile, CPI over in Europe was steady at 2.4%. Core inflation slowed to 2.7 from 2.9. So that just strengthened confidence that they are going to cut rates this June, coming in a rate cut, the ECB, before the Feds do, which is going to further strengthen the euro dollar. So being long the euro makes more sense to me at this time. And then, of course, if we go over to the Asian markets, you can see both the Nikkei, China, and Hang Seng all in the green. Green year to date. The Nikkei is kind of leading the way with everybody at 14.26%. And over there in Japan, there's a lot of perception that Japan, the bank, has already intervened somewhat in the foreign exchange market. We've seen the yen move from 158 to 153 to the dollar. I think and as you guys know, I've been talking about the yen for about 90 days, saying being long the yen is where you want to be. And we're also getting strong earnings out of Japan as well, or better than expectations. In fact, about 2/3 of Japanese companies have already reported higher profits. So that's going to continue to lift the Nikkei. And then, of course, if we go over to China, they had a holiday shortened week, like most of Europe, with Wednesday being a Labor Day holiday for a lot of countries, except here in the U.S. Chinese stocks, they moved up more on the hopes that the government's going to continue to throw support out there. Remember, there's only two countries putting stimulus in the economy right now, the Nikkei and China, okay, or Japan and China. They just had over in China their 24-member Politburo meeting. That's their top decision-making body. And China, they pledged to put more monetary and fiscal support into their economy to shore up their demand, consumer demand. Their PMI was better than expected. It's just barely in expansion, 50.4, but it came in down from March's 50.8. So they're just barely hanging on. And their non-manufacturing PMI, their services PMI, which is usually stronger than their manufacturing, still came in below consensus at 51.2. It was at 53 the prior month. So just barely hanging on, okay? Continuing to be a drag on the Chinese economy is real estate, okay? New home sales by their top 100 developers slumped 45% in the month of April from a year prior. So real estate's still a huge drag on the Japanese economy. Now, what I'm going to do is I'm going to shift over real quick and just go through a couple of key indexes. And I'm going to show you guys what I'm talking about when I say speed bump or wall, all right? And if we look at this, you're going to see here that it's going to take a couple of seconds to come up on your screen. This is the SPX cash index. This is a 50 SMA, not an EMA. If I were to put this, change this to an EMA, which I'll show you in a minute, the S&P is above, right? But right now, that's a big hurdle right here. You can see where it held up right here. It held up right here. You can see now, about 2 months ago, you heard me say here that expect a 4 to an 8% pullback in markets in the month of April going into May. And you can see here, 5% takes us to this key fib node at 49.90. A 5% move is right down to 5,000, which is also a large number. That's typical support. Any number divisible by 1,000 tends to be a resistance or support point in a Fibonacci numerical series. And you could see there, and then the furthest one down here, we have what I call area of congruency, where we got a fib node pullback along with former all-time highs for the S&P back in January 2022. Right at that area, that would give us an 8.35% pullback. So I had said we would pull back somewhere between 4 and 8. And sure enough, our pullback hit 5.91% from the all-time highs over here of 52.64.85 on the SPX. So we pulled back just slightly under 6%, so almost right in the middle of that anticipated pullback. Now, I know a lot of market participants were expecting over a 10% formal correction, and that could be expected because we normally have at least 10% pullback every year. I mean, that's been consistent since 1950 in the markets. And granted, there are some years that we don't have, but this the question everybody's asking now is this dip over, and it is a buy the dip now, or should we wait for a further pullback? Well, the way the markets are looking right now and lining up, you've got to be very careful here. Unless we move back up over the 5150 area, which is another key fib node, just slightly higher right here, or extension node, then I think the odds favor a little bit of a pullback to come back down and even take out the lows that we made here, 49.53, probably down to 4900, maybe 48.50, somewhere in this area here. And I'm not looking for that. And obviously, we had a strong week with momentum finishing strong price action wise, which would suggest we could see the momentum continue for another week or two. But remember, we got some key data coming out in the month of May, not as much as we had in April, but we got CPI data coming out, not this coming week, but the next week. We're continuing to get earnings, but we've got about only 20% of the S&P company out so far. So this next week, I think we got like 56 companies reporting earnings and just one Dow. So most of them have come in and beat expectations. So that's kind of where we are earnings wise. So it's going to be a quiet market. And you've heard the saying, never short a quiet market or a dull market. But because it's dull and because we got some key inflation data hitting the wires, not this week, but next, it does give us the opportunity to see risk to the downside. So the risk of a bigger move right now is still downside risk. Okay. Should we clear this bar here, the 50 SMA, and this key fib extension of prior pivot highs, then this would suggest we're going to run up to the 5200 level. And that would give us a nice little move for the next 7 or 8 days until we go into the CPI. If the CPI data and core inflation comes in higher than expected, we're going to roll back over and probably make new lows. So that's kind of what I'm seeing here. You can see this colored bar here. It's suggesting that should we break through here, then we can make new all-time highs going into July timeframe. Okay, so these are just what I'm looking at here. The odds favor a little bit more downside. All right, but should we clear these key hurdles up through around 5150, then I do believe we're going to see more upside. Okay, so that's a little bit about some of the things that I'm seeing here in the SPX. Now I'm going to show you the E-mini futures. Let me just take it over here and show you the E-mini S&P 500 futures. And now I've got it on an EMA instead of an SMA for the 50 moving average. And you're going to see here where we've taken out the EMA right here, right? And now we're sitting just under this resistance zone right here at 5170. Again, I've got a colored bar up here showing that should we get the numbers lining up for us, we can probably make new highs over the next 2 months. But I'm showing risk is still to the downside. All right, so we've got to be very careful. We made a low and a higher low here. So this higher low here, should this higher low, let me just mark it on here for you guys so you can see it. Should this higher low get taken out right there, right around 50.35, then we've got a key low sitting right at this level right there. Whoops, let me just hit the wrong button. Get this in right there like that. So if we take out that 5,037, then coming down to 5,000 would make sense. Should we take out 49.63, we're going to go lower. So these are the key numbers that I'm following here. We got a couple of railroad tracks above and below. So where do we go from here? Well, like I said, momentum should carry us a little bit higher into next week. But then once we start getting some of that key inflation data, based on what Boom Powell said at his press conference last Wednesday, which was mostly dovish, by the way, um, then that would suggest we're going to move higher. But if we get bad data, we're going to move lower. So right now, it seems we're hanging on every inflationary data report. And of course, if we come up here and we look at, let's look at NASDAQ. If we look at NASDAQ futures, and you're going to see over here on these NASDAQ futures, where we're also above, it looks just like the S&P, right? We took out the 50 EMA, we made a new pivot high right here out of this previous pivot high. But this is going to suggest a rollover here as well, right? We came very close to going into the red for the year back on April 19th, okay? But now we've made new pivot highs, so we're going to see if we can hold this 50 EMA. I suspect we will challenge that 50 EMA, much like the E-mini S&P. We're probably going to challenge that 50 EMA. So look for a challenge. That's around 51.15. We're at 51.61 right now, so we may move up a little bit, come back and test that 51.15. We'll see if we can hold it. And then, of course, if we look at the rut, finally, barely back into the green. You could see here that was the demarcation between being in the red and being in the green for the year. We finally moved up, barely in the green. We're at 29 basis points in the green for the year for the rut. Okay, you could see how the 200 EMA held us up. This is an EMA for the for the 50. We'll probably end up testing that again. But again, just like the NASDAQ, this move higher suggests a higher probability of a rollover rather than going higher. So all the indexes suggest a higher probability of a rollover when this momentum from this past week slows down and comes to a stop. Unless we take out key resistance levels, that is going to be the path of least resistance for the markets. And of course, if we look at the VIX, you can see it's pretty much given it up. This was the slow and steady grind. And when you get this, you do get the pop. And there was the pop right here in the month of April. And then we've given it all up. And we're back into the green again, right? So, and then of course, if we look at the front skew, front month skew in the VIX, we're in the green, but not by a lot, right? I mean, it's still elevated, the front skew, and this is the VIX compared to the May futures contract. And if we look at the back month skew, right, this is May and June, we're deeper into the green. So that does suggest there's still risk out through May. This is, I think the markets are reading what I'm reading on the charts is until we take out these key resistance levels up above, the path of least resistance for the markets is downside action, okay? And then, of course, if we look at the bond market right here, you can see here that it did make new lows on April 25th, and we're just now up here on this. That does suggest a little bit of a challenge here. And until we get the inflation issue resolved and what the Feds are going to do, then I think the bonds are going to be very choppy down at these levels down here. Although I do believe the path of least resistance for the bonds is to the upside, which means interest rates to the downside. And then, of course, if we look at the US dollar, like I said on the dollar, we made new highs on May 1st, and then you could see that huge drop off. The Elliott wave count suggests that we can move up higher on the dollar. If we get up here, that means rates are going to stay higher for longer. We get bad news on inflation in a couple of weeks. The euro is going to go lower. And this is kind of like a risk off type of scenario here, should the dollar go higher. If we chop around here and then it breaks the 200 going lower, that'll be bullish for the markets. You can see there is no divergence on here. That does suggest, just like all the other indexes, the path of least resistance for the dollar is to the upside, which is going to put downward pressure on the equity markets, downward pressure on the euro. And then, of course, if we look at the yen, this has been one of my favorites. Right here, I've been bullish the yen, even back over here. I got in a little bit early, but I have been suggesting you want to be long the yen. It's going to find natural resistance here, hold up over the 50 EMA and my original support zone right here. We may even back off a little bit before it makes another run, but long term, you want to be bullish the yen, okay? The yen dollar if you wanted to play that. trade. That would be easier trade to play than the yen euro, all right? Because I think the euro is also going to be stronger. And if we look at the euro, it has also made new lows for the year until it clears the 50 and the 200. Not we're in a death cross where the 50 is below the 200 moving average, but until we can clear up to this level, then you want to be very careful with the euro. Again, chart action suggests the euro is going to roll lower, the dollar is going to go higher, inflation is going to come in stronger, and the markets are going to have that other rollover. That's what the charts are saying. So there's a lot, really. That's why I said, with the market, is it a speed bump or a wall? Speed bump meaning just 4 or 5% pullback. We're done. We're going to make new highs. Or is it really a wall and we're going to roll back over again? And we're going to need a little bit more data to be able to call it before I can call it. But indexes suggest it's going to roll back over, right? And price action suggests. If we look at the dollar, or the gold, you can see gold right here is holding these levels up here. I think gold's going to move higher. But for our members, I showed you guys the best way to trade this. I said gold will probably find support somewhere between 2234, 2250, somewhere in that area there. If it gets down there, it'd be worth buying. And the same thing with silver. Silver was down just a little bit on Friday, but you can see silver's holding the 50 EMA. Just like gold, there is no divergence there. That suggests any dip should be bought in both of these. Then, of course, if we look at oil, it's pulled back to the high 70s, which is what I said it would do. It actually came down and broke the 200 EMA, all right? A little bit further than I thought it would go. There was no divergence there. But again, when oil starts selling off with an economy that should be in a expansion mode, or at least in a consolidation mode, and oil is selling off, that means that there's not a lot of confidence in the energy market, in the manufacturing market, in the global market. So that's not necessarily that good, right? So we're going to have to watch this very closely. I had said that oil would probably pull back to the high 70s, right in this 200 EMA. We overshot a little bit. Let's see where we go. And then, of course, if we look at gasoline, this is the spread. Let me find gasoline futures. If we look at gasoline futures, you can see here it's pulling back too. So that's going to help inflation. Although keep in mind, in core, you don't include food and energy. And food is a big component of just everyday American household for inflationary pressures. But you could see here gasoline is coming down like oil. So that should help on the outside peripheral of inflation, right? And then, of course, if we look at nat gas, I said down at these levels down here, you want to be long. We actually came down and hit that level there. This is just, to me, a screaming. You wanted to be neutral to long in nat gas. So that's kind of what I'm seeing there, these major indexes. All right, everybody, that's a really quick update on where I see the markets right now. Members, I will see you in our chat room or in our webinar Sunday, tomorrow evening at 7 p.m. Otherwise, have a great weekend. Enjoy the Kentucky Derby for all you folks out there. Looks like it's going to be a fun race. Take care, folks. Ciao now.